In this video, we're going to have a look at business failures. Now, we live in a capitalist market-based system, so you could argue that failure is an inherent part of the system, and there's this Schumpeterian idea of creative destruction and so on and so forth. But there's failure and there's failure. And a business failure, of course, it can result from being outcompeted. So like with evolution, for example, and that's one thing. But Ponzi schemes and fraud are something completely different. They try to look like businesses, though, so it's important for us to be able to recognize them so that we can know them when we see them. And when they fail, when Ponzi schemes and frauds fail, they have a tendency to drag other businesses down with them or affect other businesses as well. So again, it's important that we study them. Now, Ponzi schemes and frauds, they often result in bankruptcy. That's one outcome, which is very common. But the typical reason for companies going bankrupt is not frauds or Ponzi schemes. It's that you're getting outcompeted, that you fail to adapt, that you mismanage your company, or you're just being passive and lazy and complacent. So we're going to have a look at these different things in this video. So let's start. First of all, we want to visualize these different things so we have them sort of clearly defined. So first of all, these are not based on data points. So this is a visualization. The size of the circles doesn't represent underlying data, but it's a good visualization. So if we start with Ponzi schemes, they are inside the fraud circle. So Ponzi schemes are kind of fraud. Ponzi schemes are actually quite uncommon, and we'll talk about how they work. They're quite exotic. Now, fraud is a broader concept. And the typical example of fraud would be accounting fraud. So basically, when a company messes around with its own numbers in a way that's not allowed. There's also management discretion when it comes to accounting, but that's something different. You might have that when you have mismanagement, but fraud is when you break rules or laws. Sometimes it's hard to tell the difference between fraud and mismanagement, but we'll talk about that. Let's move on. So let's start by looking at this exotic variety called Ponzi schemes and some pyramid schemes and similar things so that we know how to recognize them. Now, this is Charles Ponzi, or Carlo Ponzi, as his real name was, an Italian immigrant. Now, this is also Charles Ponzi. So Ponzi ran a Ponzi scheme, as it were, in 1920 in the United States, which basically promised people a 50% return in 45 days. So basically he was saying that you could double your money in 3 months. And that's the typical template of a Ponzi scheme. You might also end up in jail, right? But the typical template of a Ponzi scheme is that you promise very high returns in a very short amount of time. So that's clearly something, that's a red flag if you see it. Sometimes, and in the case with Ponzi himself, there is an underlying business logic. So there is sort of a business case there, but it turns out it's unrealistic or maybe it's made up. But in his case, there was an underlying business case, which was that he was supposed to take prepaid stamped envelopes or stamps from Italy and buy them cheaply there and sell them in the United States. So this was like return postage stamps or something similar. So there was a logic there, but it was impossible to realize that idea. So yeah, but it was sort of semi-legitimate, and then it blew up because he promised these enormous returns which were not possible to deliver on in practice. That's where the name Ponzi comes from. The biggest Ponzi scheme, though, that we know of is not Ponzi himself, but Bernie Madoff, so the Madoff Ponzi scheme. Now, Madoff was a New York-based financier, and he probably started way back in the 70s. So his Ponzi scheme ran for a very, very, very long time, which makes it quite interesting. This is a visualization of the Madoff Ponzi scheme. And this sort of allows us to see that there is Madoff at the center. And this is something which is typical for Ponzi schemes. There's somebody at the center, a firm or a person, and the money sort of feeds into that center. And then the center takes money and pays out money to other people in the scheme from new investors that come in. So taking new money to pay to old so-called investors. But again, it's important we can see the Ponzi operator at the center here. So that's a difference between what we will see next. Madoff was sentenced to 150 years in jail in 2009, and he died in 2021, obviously not having served the full sentence. So Ponzi schemes are different from pyramid schemes. Pyramid schemes, which this is an illustration of, are basically a recruitment game where you're supposed to recruit a number of recruits who pay a sort of membership fee or some kind of fee, which you get, and then maybe feed up also in the pyramid. The problem with pyramid schemes, obviously, is that they assume exponential growth, or they imply exponential growth. So if you have a pyramid scheme with one starting person who recruits 6 persons, and each person is supposed to recruit 6 other persons, then you end up with this. So already at the 13th step, you have more participants than the entire world population. So this makes pyramid schemes sort of impossible in the long run, and they can run for a short or a long period of time, but typically it's a short period of time. It also is a nice illustration of the power of exponential functions right here. Now, multi-level marketing schemes, they incorporate parts of this pyramid scheme, but they also have products. So you typically sell and resell products, and you get a commission on that from the persons who you recruit. But it incorporates parts of this pyramid. So let's move on to fraud, which again is more common. So here we're going to have a look at 3 different types of fraud so that we can learn how to recognize them. So let's start with the most famous case, arguably, of corporate fraud, or one of the most famous ones. It's the Enron case. So Enron was basically an American energy trading company, but it was named the most innovative company in America during a number of years between 1996 and 2001. They filed for bankruptcy in 2001 after an accounting scandal where they basically inflated their revenues, so made the revenues look bigger, and they also made some creative changes to their balance sheet. So they moved some things off of the balance sheet to make the balance sheet look more stable. And this resulted in a number of fraud convictions, so sort of court cases. Securities fraud, wire fraud, and other convictions. So not only court cases, but actually convictions. It also led to the collapse of one of the world's biggest audit and accounting firms, so Arthur Andersen, an old American audit firm, which was dragged down by the Enron scandal. There's a great documentary about Enron called The Smartest Guys in the Room, if you want to go deeper into that. It also led, the Enron scandal also led to the Sarbanes-Oxley Act, which was basically about and is about improving accounting rules or reporting for public companies. Now, the next case we're going to look at is the Volkswagen Dieselgate fraud case. Still fraud, but a different type of fraud. So what Volkswagen basically did was they manipulated the cars to make them, their diesel cars, to make them look better from an emissions point of view. So they would take them to tests and make them look good, but in reality they would emit much more, especially NOx emissions than they were allowed to. And they did this for 11 million cars during a number of years. It didn't lead to bankruptcy. So it's one of those fraud cases which didn't lead to bankruptcy. You can ask sort of why, because some banks or some companies financing them were thinking about pulling their bank loans, but they ended up not doing it. So maybe Volkswagen was too big to fail. Maybe they didn't go bankrupt for some other reason. But it did lead to a number of fraud charges, and there are still ongoing trials a number of years later. It also led to more than $33 billion in fines and penalties and so on. So one of the biggest corporate fines complexes in history, probably. It also led to stricter emissions rules and regulations, and you can argue that the Volkswagen or the Dieselgate scandal also was a driving force behind electric vehicles or the adoption of electric vehicles. Now, the third case we're going to look at is a different type of fraud case. So it's still fraud. It's an American bank, a huge bank called Wells Fargo, one of the biggest financial players in the US. We can call this incentives gate. So they had this idea about cross-selling, and their CEO was very vocal about cross-selling. So he said 8 is great. That meant that each customer of Wells Fargo was supposed to have 8 different products. So this, maybe not surprisingly, resulted in their sales force, the persons interacting with clients, faking a lot of client accounts. So they created more than 3.5 million fake accounts, and they moved money around and so on and so forth to drive sort of revenue, but in general to kind of drive this metric that the CEO was looking for, which was a number of accounts. Also didn't lead to bankruptcy, so they didn't lose their banking license, or although maybe they should have. Could also argue about whether Wells Fargo was considered too big to fail. did lead to billions of dollars in fines and penalties. There are still ongoing criminal cases and so on and so forth. Again, it's not really accounting fraud as such, although there was probably part of that in there. But it's more of sort of messing around with the numbers internally. Still fraud, but a different type of fraud. So faking numbers, but not necessarily accounting numbers. So here we're going to now in the next part get into the most common type, which is mismanagement and complacency. So you can argue that there is mismanagement and complacency in a number of companies and that you cannot see most of that from the outside. So what we're going to do here is we're going to sort of look at some real data. We like to do that. So we're going to look at bankruptcy data, and then we're going to talk about mismanagement and complacency in general. It's also worth pointing out, though, that there are many companies that are probably mismanaged or that are complacent that don't go bankrupt, but they still sort of lose out in the end. So examples of that would be, for example, Nokia, which used to be the dominant player with 40% of the mobile phone market globally, or GE, General Electric. So both of those companies sort of lost. They are still around, but they are much smaller than what they used to be. So what we're looking at here is the 10 largest US bankruptcies by asset size. So you can sort of look at it from different perspectives, but this is how much assets that each company had at the time of bankruptcy. So we have the Lehman Brothers bankruptcy from the great financial crisis. We have Washington Mutual and Silicon Valley Bank and Signature Bank. So we can sort of see that 4 of these top 10 bankruptcies are financial institutions. Now, Lehman Brothers was famously an investment bank, and they made bad bets related to the subprime crisis, for example. Washington Mutual is a savings and loan, but it's basically a bank as well. So Silicon Valley Bank and Signature Bank, obviously banks. If we move further down, CIT Group in 8th place, it's also a bank, actually. There's a special story there. So they went into bankruptcy protection, which is called Chapter 11 in the United States, in November 2009, and they came out of bankruptcy protection in December 2009. So that's something that you can do in the United States. You can move in and out of bankruptcy, and that's what they did, but they still went bankrupt. In 10th place, we have Conseco. It's an insurance and finance company as well in the United States. So sort of in total, 6 out of these 10 largest US bankruptcies, and this is fresh data from 2023, 6 of the 10 largest were financial institutions. And in most cases, it wasn't fraud. So that's kind of moving on from the previous topic. So there was some fraud with Lehman Brothers, for example, which is an entire story in itself. But 6 out of 10 financial institutions. And if we look at the other ones, so WorldCom, telecommunications company, plain fraud, interesting case as well. GM, General Motors, they kind of lost revenue before the financial crisis, but they had a high fixed cost base, and they had a lot of pensions obligations, which they had to sort of pay out in the future. So they sort of ended up not being financially viable, and they had to move into bankruptcy protection, and then they came out of it being recapitalized, and they were basically saved by the US government. Pacific Gas actually went bankrupt a few times, at least twice, and this listing here, or this time they went bankrupt in 2019, was because they caused a number of fires, a number of problems, so that sort of made them go bankrupt, probably because of mismanagement. We also have the Enron scandal in 9th place, so it's one of the biggest corporate bankruptcies in US history. And that was fraud as well. But we can see that most of them are not fraud. They are something else. We can also take a step back and reflect on the fact that most of these were actually financial institutions. So is being a financial institution, is being a bank doing the right it? By definition, financial institutions use leverage, or they incorporate leverage in their business models. And their upside-downside risk seems to be skewed. So we know that, for example, the return on equity for banks is not that amazing. So it seems like you're taking a lot of risk, and the return on the upside is not that big. Now, even if you would have high returns in banks, maybe it still wouldn't be a great business to be in because of this seeming significant bankruptcy risk. Also, of course, we're not looking at the entire database of banks, but it says something that the number of the biggest bankruptcies are banks and financial institutions. The way that banks go bankrupt. That's very interesting in itself, and that's a topic for another video.